Welcome to the NAFA webinar series, providing you with timely information and training on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today, we are presenting best practices for utilizing home equity in retirement, sponsored by Retirement Funding Solutions. Despite many clients' largest retirement asset, home equity is sometimes not considered. Today, Jamie Hopkins, professor at the American College, will discuss a variety of effective home equity strategies, including reverse mortgages, downsizing traditional loans, single-purpose loans, house sharing, and sale leaseback arrangements. Jamie Hopkins is a professor in the Retirement Income Program at the American College of Financial Services. He is also the director of the New York Life Center for Retirement Income and writes about retirement planning for Forbes. Professor Hopkins has also been selected by the American Bar Association as one of the top 40 young attorneys in the country and listed by Investment News as one of the top 40 financial service professionals under the age of 40. During the webinar, you may type your questions in the question box on the right side of your screen. All questions will be answered during the question and answer session at the end of the webinar. This webinar is being recorded, and a web link to the webinar recording will be emailed to you. Jamie, welcome to the webinar.
Brendan, thank you for the introduction, and I always love hearing a little bit about myself before I get started. I think it encourages me to do a better job. So. I appreciate everyone taking the time to be here live, and for those of you watching the recording, thank you for taking the time out to watch it too. Also want to thank NAFA for having us here, and also for having us down. I'll be presenting a little bit down at the 2017 Performance and Purpose Annual Conference in Orlando in just a couple weeks. So I'll be glad to see you at my session down there too. So again, my name is Jamie Hopkins. I'm going to be leading us through this webinar today about home equity and retirement. What I hope is actually some of you that are here are not the ones that have already bought into the concept of considering home equity. I hope some of you say, I'm not a big fan of this strategy yet, and I don't use it a lot, because I want to get a different message out to different people, and that's really going to be my hope here. But if you are a believer in it, great, and we'll hopefully be able to teach you some new things here too. Just a quick overview of the webcast. I'm just going to kind of introduce the American College, who most of you are probably familiar with, the discussion about home equity in general, a little bit about understanding your clients. What are they thinking? How do they feel about home equity? Some recent research that was just published this year on that. Then we'll actually get into some of the different strategies for improving and maximizing retirement income by kind of tapping into home equity and really just considering it as part of holistic planning, right? That you can maximize other income sources by effectively rebalancing and using home equity. There's a picture of me up here and just a little bit about the American College. As I said, I was the director of the Retirement Income Center here at the American College, where we run the RICP, Retirement Income Certified Professional designation, a number of other research projects, free video content online, and we do a number of events with NAFA, including this webinar. If anyone has questions about any American College thing, please feel free to reach out to me afterwards, whether it's a designation or research, or if you're an alumni, I'd be happy to speak with you. Also want to thank Retirement Funding Solutions, a great company that's for sponsoring this webinar and other events at NAFA. They actually do reverse mortgages and have, as a unique position by them, actually have advisors, or at least I should say reverse mortgage professionals, pretty much in every state. So if you are an advisor who's looking at getting into this world, or at least having a contact that you can send somebody to as a client if they need help, it's a great resource and company to consider. They're not the only great company out there, but they are one that's kind of uniquely positioned to have advisors in different states that can help financial advisors with reverse mortgages if that's a route that you want to go. So let's get into the actual webinar now. It's just the first question is always, why home equity? And I like to frame this in the sense of retirement income planning, and that's really the focus of this is, home equity and retirement planning. And so what is retirement planning? One of my favorite quotes about retirement planning is that retirement income planning is like hitting a moving target in the wind, right? You don't know how far away that target is or how big it's going to be because it's, always changing, right? It's moving forward and back. It's a moving target. And why is it moving forward and back? We don't know what the stock market's going to do. You don't know how long you're going to live, when you're going to retire. So the goal is difficult to hit. Not only that, there's winds. And what are the winds? The winds are all the changes and the risks that are going to occur throughout retirement, whether it's public policy risk and the government changes taxes or Social Security benefits. And then your plan can't follow the same line it used to. And, then how do we get there? Well, really, we need to make adjustments over time. We need to be flexible. We need to consider all of the assets that we have at our disposal. And, we're really doing goal-based planning. We're trying to hit that target or come as close to it as we possibly can, but understanding that there's going to be challenges and risks and changes over time, that we're not just going to set one plan for all clients and then leave it. And so then I have, what's a style of a retirement income planning process. And because this really is goal-based planning, we start with the client's situation, their goals. Then we estimate the retirement income needs. Then we look at all the available sources of income and assets to kind of say, how do we get to our target? Well, we're going to use everything at our disposal that we can. We'll then do some type of calculation, see if there's a shortfall, address risks, put a plan into place, and then review it over time. And as I pull that one out, right, we want to identify sources of income and assets available to generate retirement income. Well, when you look at the average American couple reaching age 65, and I really do say average because this is the median, not the mean. And so this is what really kind of the true average couple looks like at 65. Now, these numbers might have gone up a little bit here. This is from the last U.S. Census data. But again, the percentages really won't have moved significantly at this point. But when you look at this, the green, what is the green? That's value in their home. And what's the blue? That's all the investment assets. And so what you see is two very important things here. One, Americans don't have a lot saved when it comes to retirement, right? About 92,000, maybe 100,000 today of investable assets, and maybe about $200,000 in their home. Not a tremendous amount of savings. And we're all fairly familiar with that Americans are going to struggle to meet their income needs in retirement. But what this also tells you, right, is that where's America's largest asset? America's largest asset is their home. It's going to be a lot of your clients' homes. And actually, if you go further into the data, which I don't have up on the screen here, but when you go further into the data, you find out that really you have to get to about the top 10%, top 8% of the country before home equity is really less than 50% of their assets. So not only is the median and everyone below this kind of heavily weighted towards their home, but you really have to be looking at a small percentage of Americans before home equity is not more than half of their wealth. And so that should be very telling. And I think this is very telling to me because I always sit here and say, can you do comprehensive planning if you're ignoring the green part of this chart? If you had to stand in front of a judge and say, hi, I'm a comprehensive financial planner, but I ignore the green part of my chart. Now imagine looking at this same chart right here on the screen and saying that this was your stock to bond investment. That's actually a very reasonable stock to bond investment strategy, right? 68-32, 70-30, 60-40 split, very reasonable. And if that was your split and you were in front of a court and trying to explain your planning and you said, I'm an investment manager, and the stocks were the green one. You said, but I don't do stocks, but I'm a comprehensive investment manager. And you just blocked out the green part. Say, I only focus on bonds. Would you really be a comprehensive investment manager? I think the answer would be no. And so part of the question then is, can you do comprehensive or holistic planning and exclude home equity? I think I would challenge anyone that says they can because it's such a large portion of your client's wealth. can you really exclude 2/3 of your client's wealth and savings and say you're doing comprehensive or holistic planning? I think that's a hard argument to make. Now, you can do holistic planning in an area and still ignore it. You can be a holistic risk management and insurance professional and ignore home equity. You can be a comprehensive and holistic investment asset specialist, and then I think you could exclude home equity as a pure investment class. You say it's a type of savings, but not investments, at least securities. So in different areas you could, but I think that general financial planner or retirement income planner is saying they're being holistic. I think that's a challenge. And then today it also brings up the idea, what about the fiduciary advisor? Now, there's nowhere, really under state law, whether under insurance regulations or securities law or the Department of Labor rule that really touches on providing advice around home equity and that's somehow required. And there really haven't been any court cases pushing that yet. But I think it's an interesting area to think about at this point and say, where does that line go? If we're talking about we need to now be holistic about distributions from retirement plans, if we are going to be acting as a Department of Labor or ERISA fiduciary, then where does the line go? Does giving advice about distributions from qualified plans, trying to maximize a client's wealth, do what's in their best interest, if we ignore the fact that their client is so heavily invested in their home, and we don't consider that as a factor when giving advice about their plan, their investments, or distributions, are we really doing our job as a fiduciary? Wouldn't a prudent advisor look at all of the person's assets? I mean, I think the answer is yes. We would agree that you would have to look at their human capital, I'm sure, which even though that's not an investable asset, it's not a traditional asset, but do we need to know where they are in their life cycle, right? That they're still young. Does that impact their investments? Of course it does. It impacts their risk and other tolerance. So wouldn't their home and their home equity also impact some of those factors? I think the answer is yes, especially now that we've seen a growing a growing surge of research showing how when home equity incorporated into financial planning can improve a client's situation. It's hard to say that we should not do it because there's actually evidence out there saying you should. And so how do we pay attention to that? And places like FINRA and CFPB, I mean, they discuss home equity as part of the planning. And they say, you should be considering this. FINRA actually says that, right? And including reverse mortgages, that it can be properly used and you should consider it as a planner. So if you decide then that, okay, this is an area that I want to service to some degree, what can I do? And what should I be doing? Because it's probably new to you. You probably don't get paid on it as an advisor to provide specifically reverse mortgage or home equity planning with retirees, but is it part of your planning process? Are you holding yourself out as a comprehensive planner? And so what do you need to know about your client? And so there's some new research that was published in Journal of Financial Planning, which I know many of you probably read, that discusses this. It was a literacy and home equity planning survey that was done here by the American College, and then some of the research was analyzed and published in the Journal of Financial Planning in May 2017, so fairly fresh data here. And it really asking people about the decisions they made about their housing, how they felt about housing, and then kind of gauging their knowledge on home equity planning and reverse mortgages. And so it's a fairly large study, over 1,000 people, and with more than 100,000 investable assets and over $100,000 in home equity. And the demographics here might look something like your clients, pretty close to 50-50 male-female split. Most of them had a financial advisor. A good portion had a written comprehensive retirement plan. A lot of them had over $500,000 of home equity. It's a group that, is not the kind of low income, low wealth people, but, middle to upper income individuals. And most of them were over the age of 62. Again, looking at a group that's nearing retirement or in retirement to kind of gauge how they feel about this. And one of the best takeaways from it was people that had wanted to age in place. And so that's important to know about your client. I think that's a great question when you're doing planning to say, well, have you thought about where you want to live in retirement yet? That's just, that's one of the most important decisions you're going to have to make, right? Because you're going to be spending a lot of time at home, most likely. Maybe not at the first couple months, but you will be spending time at home. And obviously, you're going to have clients that say, no, well, we're going to sell the home and move and travel, and that's perfectly fine because we're doing goal-based planning here. So we want to know about what the client wants to do. But we saw in this survey that 83% of respondents said they want to age in their current home for as long as possible. Now, that actually matches up with a lot of the other data out there in the world that shows pretty similar numbers. And in addition to that, the desire to age in place, right? How long somebody expected to stay in their home and how long they wanted to be there increased as the person ages. And so that's not real surprising, right? When you're 60, 55, you might still be thinking that we're going to move one time before retirement or early in retirement. But once you get to 70, 72, you're really not expecting to move anymore. The hassles of moving, you've now become accustomed to retirement in your house. Clients don't want to move. They want to age in place. The reality is a lot of people will pass away in an institutional setting, though. So at some point, right, even if it's just the last couple days, weeks, they're probably going to move out at some point. But a number of people do pass away in their homes. And this is, one of those fun concepts, right? You want to age in place there. But then at some point, we'll also have to deal with what happens when you pass away. And it's very interesting that people said that they want to stay there for more and more years. And a lot of people saying 20 plus years, right? They want to stay in their home. And that pretty much was matching up to what people perceive their life expectancy to be. And I thought a very interesting thing was how many people said that they would move and rent. Well, only 5% of these individuals, now all the individuals in the survey were homeowners. And that's an amazing number because we would probably make the argument in the academic world for a lot of people renting is a good deal. It's cheaper in some areas to rent, but once you own a home, once you're accustomed to owning a home, the likelihood of convincing that person to downsize their home fully and go rent is almost impossible, right? So I don't think while we will discuss that as kind of a strategy, right, from time to time, and for some people it might be the best strategy, there's this emotional attachment to the home that we're just not going to be able to overcome in a lot of those situations, and people do not want to start renting. They want to stay in their home. They want to continue to own their home. We also saw that the clients, most of them, did not consider ever using home equity as a retirement income source. So to supplement their spending, they don't think about the home as a source of income. Now, 44% did, so that's a good chunk that thought about it, but still most did not. They didn't think about it. Now, we do know some things can help with that. Having a comprehensive written plan in place did improve the likelihood that they would consider it, but still not a lot of people, only 52% with a plan in place, a comprehensive plan, actually thought about using home equity. And there is a reason for that, and I'll get to it a little bit later. Why don't more people think about this? Now, when asked as a follow-up, how comfortable do you feel spending it? Well, about a quarter of these individuals felt comfortable spending retirement income or their home equity as retirement income, which actually tells you it's still a fairly big market, right? Now, that means about 3/4 of your clients are probably going to respond and say, you know what, even if if we look at this, maybe we're not comfortable spending our home equity. It might be higher than 25% because, again, about half didn't even consider it. So if you don't consider it, if you consider it, would you be more comfortable doing it? Or is that group so opposed to it that even if they considered it, they still wouldn't be comfortable? Now, that's hard to figure out from this data, but we know at least 25% of the total client base is likely to say, I'm okay using home equity in retirement. We saw people with more wealth, with more home equity, and then men felt more comfortable also using it. So if you have, a high net worth male client, might be more inclined to use home equity as a supplement source, or at least talk about it as an income source for retirement planning. Now, one of the big holdups that you often hear is legacy. Well, what happens if I use my home equity up? I can't leave my home to my kids. And I always respond first by, well, the kids don't want it, right? They don't want your house. And we see that over and over and over again. There was even a great article out recently, the aging parents and all the stuff they have, right? Aging parents with accumulated assets and all the stuff the kids don't want, right? These houses full of tchotchkes and china sets, and kids don't want this stuff. They sell it. They sell the house too. But I actually thought this was fairly interesting. Only 20% of the respondents said leaving their actual home, not value, but the actual home was extremely important. And 45% said it was not important at all. And the rest was kind of in the middle that said maybe it's moderately important, but not extremely, and that they didn't not care about it. So you had actually kind of leaning towards this is not important. So you had a big group of people that are okay using up home equity as a supplemental source and okay not leaving it as a legacy asset. Now, what is this telling you? This is telling you these are questions you should be asking your clients, right? How important is it to leave your home as an actual home to your kids? Do they want it? Are you okay with using home equity as part of your retirement? Would you be willing to look at it, right? And so some of these can get us down the path of how far do we go with home equity planning with our clients. Now, the next one is going to tie us to some of our best case strategies later on, which is, did you consider reverse mortgage? Now, this dropped way down, not surprisingly to me at all, that less people considered using a reverse mortgage than really any of the other options. So it's only 14% of respondents said that had considered a reverse mortgage. So small group of people, and part of that is also because, again, financial advisors have not been very involved in this world, and so they're kind of not moving the needle for their clients. So a lot of clients are looking at this regardless of their relationship with an advisor. And then we asked the follow-up, just why didn't you use a reverse mortgage? And this one was actually a forced response, so they actually had to pick something. Of those who looked at it, most people said that they just didn't need it, right? That was the most frequent response. 44% said we didn't enter to reverse mortgage because we didn't need the money after looking at it. Amazingly, after all the people in this survey, there was only one that actually engaged in a reverse mortgage. Good news is they did very well on the knowledge check question. So I guess that was encouraging, the one person who entered into one. We had a large group that said they were too young to engage in reverse mortgage. Now, that one I kind of question what that meant, that they were going to wait till later in their life to consider it again, or that they weren't 62, so they couldn't enter into one. The age restriction, I'm still kind of question how respondents really viewed that, right? You always try to say, can respondents, are they answering the question that's being asked? Some just said that they weren't ready. Some said because they're not retired yet. Some said because they're planning on moving. And so there was some implication that this group, this 14%, at least reviewed it and said, you know what, I would use it, but there are some reasons I haven't used it yet. Now, another question here was, how did these clients view it as a positive tool? Now, this is very interesting because of the skewedness of the data. And so skewed in the sense of we kind of had these large tails on the end, that the average response was a 3 out of 7 on a Likert scale, meaning that the total respondents skewed over to not viewing reverse mortgages as a positive tool to improve their retirement security. Now, 10% of respondents listed the highest possible number, the 7, which is a large amount of people. It means out of these 1,000, 100 of them said, yes, I completely agree that this is a beneficial tool. But 35% were at the lowest range, right? The 1 that strongly disagreed. And so you have very polarized views on this, that people are saying, yes, I very much understand the benefit, and a group that's saying, you know what, I really do not believe that I should use a reverse mortgage. I view it as very harmful. And so then kind of wrapping up this section is, right, what does your client possibly look like, right? They have a lot of wealth in their home. They want to age in place. They don't want to rent, right? they probably, it's kind of up in the air whether or not they've ever even thought about home equity as an income source. About 25% of them are going to be okay using home equity as an income source. A couple of them, right, 20% are going to be really hesitant to do anything that might impact their ability to leave their home as a legacy asset to their children. Whether or not their children want it, different question. And, the kind of last 2 points are together. They really don't understand reverse mortgages well, and they probably hold a negative view of reverse mortgages, at least going into their first conversation. So these are all points that an advisor should know about their client. And these are things you can ask your clients. You can talk to them and say, where do we kind of fall on these? When we talk about home equity, where are we? When we talk about living in retirement and your housing, where do we fall on this scale? And so, as the last one said, they don't know a lot about reverse mortgages, and that was actually tested in here too. And not surprisingly, people think they're smarter than they are. It's whenever you ask a room, that nobody ever thinks they're in the bottom, half of intelligence or in the bottom half of health. Most people on that side are always like, oh yeah, I'm an above average smart person. I'm above average worker. I work harder probably than the average person in my job, and I'm smarter than the average person too. So reverse mortgage knowledge kind of was a little bit above kind of the average. People thought they were moderately knowledgeable. Now, there was a group, 20%, that said they were the top knowledge level on reverse mortgages. And guess what? Only about half of them could pass a 10-question true-false quiz about reverse mortgages. So there's a big misconception. It tells you that even people who think they're very knowledgeable in this area hold a lot of misconceptions. Now, there were a number of people that said they didn't have any knowledge at all. So there were some people that recognized that, but not nearly to the level of people who were saying they were extremely knowledgeable. And so what happened? There was a quiz here, 10 questions, true or false, on different aspects of reverse mortgages. Average kind of mean score here was a 4.8 out of 10, which is important. And I haven't been able to stress this enough, and actually I should get somebody to run some data on this one about kind of the randomness of this. That's pretty close to what a monkey would get, right? A completely random true-false test should come out to a 5 out of 10. And so actually people do worse than random on a reverse mortgage quiz. So what does that tell you? It should tell you something amazing right off the bat, right? They actually do worse than complete random guessing. It means that people hold a lot of misconceptions out there on this topic, right? That they think they know something that is false. And that's actually pervasive out there with reverse mortgages. Financial planners, too. Now, again, a little bit better impact on people with a comprehensive financial plan as compared to no plan. At least those with a comprehensive financial plan did random, right? They did a 5 out of 10. We've seen that in other literacy reports, too, and I bring that up because it shows a level of sophistication that you're doing comprehensive planning, you have a written plan in place, and your knowledge tends to be increased, or kind of vice versa. It's always hard to say which one, the chicken before the egg, but those people who do more comprehensive planning tend to exhibit higher levels of literacy ratings. Now, amazing here also was that 10% of respondents scored a 0. That's very hard to do on a true-false quiz, again, because there's a lot of misconceptions out there that just drive people to say, you know what, I think this is true. It sounds like it might be true, and I've heard bad things about reverse mortgages, so it must be the bad answer is the correct one. So again, kind of the biggest misconceptions about it was kind of when you should use home equity in retirement, and then also that the heirs have to repay debt above and beyond the house value, meaning that most people did not understand the aspect of a non-recourse loan, that you don't owe anything more than the value of the house upon the death of the homeowners or when they stop using it as their principal residence. That's a big misconception, and that makes sense why people wouldn't understand them. A non-recourse loan idea is a complex, in some sense, idea. You don't run into a lot of those situations throughout your life. You feel like if I have a debt, I've got to pay it or someone has to pay it. So that one actually makes perfect sense to me. And also the when to use home equity makes perfect sense because even FINRA, for example, not too long ago and then not too distant past, also would talk about reverse mortgages and home equity as the last resort option. And if you talk to reverse mortgage specialists and home equity, professors and academics and people in that world, it's been tested, right? We've done this a lot, and last resort is really the default situation, right? It's if we do nothing and then you wait to do something. Well, tell me how many times in planning in any area that the default option of doing nothing is the best choice, right? It's usually not. Right now, sometimes, not acting is acting, right? That can be a good thing. But kind of generally speaking, usually inaction is usually not the best plan. And eventually, FINRA has actually removed the last resort language from their investor alert. So I still run into many people who say, FINRA says use reverse mortgages as a last resort. Well, no, FINRA actually changed their view on that, in part due to the work of Dr. Barry Sachs and the Longevity Funding Task Force led by Shelley Giordano. They've done some fantastic work and research. Wade Fowles on there, and they do a bunch of great work and have really moved the needle in the planning for retirement income and home equity, and especially reverse mortgages. Here's a list of the knowledge check questions. I'm not going to spend any more time on them. Now, one of the more interesting things about the survey was also what I say, non-impact of the financial advisor, that there was no statistical impact on a client's knowledge or likelihood to use a reverse mortgage if they had a relationship with a financial advisor, which tells you what? It tells you that financial advisors are not doing this. And we know that already from kind of the anecdotal world of talking to financial advisors and financial service firms, that a lot of firms prohibit the recommendation of, decisions around home equity reverse mortgages. But as I said, kind of going back to the beginning, can we say that we're comprehensive? Can we say we're doing holistic retirement planning if we're excluding the client's largest asset and effective ways to improve their situation? Are we doing a disservice for our clients by not including such a large asset and a potentially valuable income tool as a reverse mortgage and downsizing and HELOCs and home sharing can be? And so advisors just aren't doing this today, and I think that needs to change. We've had a Nobel laureate, Robert Merton from MIT, even say, this is going to be the key to the baby boomers' retirement, that without home equity, it's not going to work. It's their largest asset. We can't just rely on Social Security. And so kind of my thoughts on, as I said, some of the reasons why advisors aren't doing this. Companies have been slow to adopt it, right? Compliance departments, some prohibit the use of it, prohibit advisors to talk about reverse mortgages. Another big thing is, unfortunately, we know this is the world, that advisors don't make money on the product. And if you don't make money on something, you're going to be less inclined, just from a business standpoint of view, to adopt it. That makes sense. But as we start moving to generalist planning and away from product sales, that's actually where we see the largest number of places using reverse mortgage out there. Some of the RIA firms and independents, that they're understanding, I don't have to make money off of this because it's good for my client. And if I do the right things for my clients, that's what I should be doing. And the revenue will be there, right? It's not going to cost me money. And by supporting my client's portfolio, that can again be beneficial to me from a financial standpoint. Now, you can't really get to reverse mortgages without acknowledging that there's been problems with them, right? That there's been bad publicity, and the product has had to change over time to address some of the issues. That, this was a product like many other products that were rolled out and weren't perfect to begin with. Life insurance had a bunch of problems when it was initially rolled out, and laws and companies have changed policies to address that. Annuities, same thing. Traditional mortgages, same thing. It's like all the other products and services that we have out there that need to grow over time. And it looks like reverse mortgages are in a much healthier and secure place today than they were a decade and a and a half ago. And so there's been kind of a slow growth there over the last couple years, a little bit of adoptance from the financial advisor community. And the other thing is your advisors have never been trained on these products in home equity. They don't usually know exactly how to talk to clients about this. They don't know how to talk to their company and push compliance on this. And I think that's going to be a big step in the future, that financial advisors need to be the one that drives this change in companies, that you need to challenge compliance. And that doesn't mean that you're going to be disrespectful or tell them you need something, but say, hey, maybe we should review this again. Did you read Wade Fowle's research on this? Did you read, Dr. Barry Sachs from MIT's research on this? You don't have to believe me. Let's look at some of the smartest people out there and say, look at what they're doing with it, and then start to develop some best practices over time. And I think that challenge needs to occur, that drive needs to occur from financial advisors. I've actually heard from compliance departments that one of the reasons they haven't made changes is because they haven't had a big swell in requests from advisors in certain areas. So it is a way that you can change the world. And I think to do what's in the best interest of your clients, sometimes we do need to challenge the business processes that are in place inside the company. And I'm sure your compliance departments love hearing that from me, right? Telling them to go change everything. But I think in reality, right, you're the one dealing with the clients as an advisor, and you know what they need. And you probably have asked for changes and different techniques and products, services, technology in the past, and that's gone through the business process. And not every company is going to adopt it, but some will. And so then let's get kind of over to some of the actual using of home equity income solutions as part of a retirement income plan. And as I have up here, kind of 8 different solutions, some in which we actually sell the home and maybe move, and then some where we're going to age in place. So the first one's downsizing, right? Obviously, downsizing is, in a lot of cases, maybe the best strategy for a client. Actually sell the home and move out, move to a CCRC. And I actually separate that one out because I think of downsizing as moving to another freestanding home. But you can also sell the home and move to some type of continued care retirement community in which other services and benefits are provided. You could just rely on charity and move in with family members, or a sale leaseback maybe in which you're engaging in some sale of your home to a family member. Home sharing, right, which is what I would say the golden girl situation, where you're bringing other people into your home. And these ones on the right-hand side are aging in place, right, which we saw most of your clients want to do. But special purpose loan we'll talk about briefly, and I have slides for these, so if you're wondering why I'm flying through them, that's why. A traditional HELOC, home equity line of credit, and then we'll talk again about reverse mortgages. So first one here is kind of the downsizing, selling the home, moving to another home, or going into a CCRC or renting. As we saw, most people don't want to rent, so while you might be an option, it's a very low percentage of people that want to do that. That brings on a bunch of other risks. Why would you downsize or sell your home? Well, from a financial standpoint, it's because you could free up cash, right? We could cash out a portion of our home equity. But most people move in retirement not to free up cash. They actually move it for lifestyle decisions. They want to move closer to family members. Their health is changing. And for some people, it is to reduce expenses, but they don't necessarily move to a cheaper home. They might move to a new area with a lower cost of living, but that can still be beneficial for your retirement income plan. Now, we see most people want to age in place, and that actually, is I think a strong reason to have the conversation with a client about downsizing too, because if we're going to do it, we should do it earlier in retirement rather than later. If you really do want to downsize, we should do it while you're healthy and this is less of a burden, as opposed to waiting a number of years and then maybe never getting around to it, right? So I think that's important. And because we also do see something here, those who actually decided to move actually exhibited a little bit more satisfaction with their retirement, that they actually made, again, an affirmative decision to change their lifestyle based on their goals. And I think that ties to one of my themes that I always use, that kind of inaction, right, can be the right thing. But usually if we set goals and we're actually proactive, we increase our happiness and our situation. So moving can be a great option, but are we actually going to get around to it? Do we want to? Are there non-financial reasons to do it? A lot of people don't want to move into a cheaper house. They might move to a smaller house with better amenities that is more aging in place friendly. Now, home sharing, not really popular in the United States, but there are a number of women using this. Tends to be more popular with women, according to the AARP study. That they said there's actually about 4 million women over age 50 living in a house with at least two 50-plus women. Not very many men, according to the AARP, doing this. And so as I refer to this as the Golden Girls housing situation, you get a number of seniors together. They move into one home, and the homeowner then is able to generate retirement income for themselves and still live with a number of their friends. And so this is going to be a unique situation, right, where you actually want to be around other people, or at least hopefully you do if you're going to bring other people into your home. There are a number of state home sharing agencies now in existence. There's a National Shared Housing Resource Center that you can go to if you have a client that's interested in this, because the contract and finding the right roommates in this situation is so important, right? That we understand that the person moving in can pay for it. You're going to get along. Your lives match up with each other. It takes a lot of work to get to a good place here. Now, another option to generate income in retirement from the home is going to be a HELOC, home equity line of credit. Now, a lot of people, when you bring up reverse mortgages and you see reporters write about them, they say, well, instead of doing a reverse mortgage, do a home equity line of credit. It can be a cheaper option, which is true. Now, there are some benefits of using home equity lines of credit. Some of the research shows that these are best used for short-term needs. So if you're going to have someone that's only going to kind of have the debt outstanding maybe for 12 to 18 months, it's to help with a leaky roof, fix something, and then they're going to pay it back in a short time period, it can be a great option to tap into home equity, pay for something you need, and then, kind of pay it off fairly quickly. And again, perhaps what I would say, engaging in a debt shifting strategy where you have a credit card debt that's built up. Well, if you can pay it off with a lower, kind of interest rate line of credit from your house, wouldn't that make sense? Yeah, that makes sense. Now, there are trade-offs for doing some of these things, right? That the credit card debt might not put your house at risk while a HELOC could, right? If you don't pay it, then all of a sudden you could lose your home, right? This could eventually result in a foreclosure if you don't repay your debts. And that's just a reality of debts, right? You don't pay debts that you need to pay currently, it can result in problems. And so not paying this can become a problem. And that's one of the issues with HELOC is the cash flow aspect of this in retirement. That if you create a debt that you also now need to pay back, does the cash flow of the retiree support this? And if they're struggling, that can be an issue. Now, another thing with this that I always bring up for retirees that want to tap into their home equity strategically in retirement and maybe bad markets. What happened during the last market crash in 2008? Well, guess what? These HELOCs that people set up thinking that they were going to utilize these in order to supplement their retirement income, to help better diversify their assets by having a line of credit in addition to their home, in addition to their investable assets. Guess what? Banks froze them. They wouldn't let people draw from them. And part of the reason here is that the home equity line of credit is usually tied to your current home price, the current value. And there was a lot of risk going on right then for banks and for people in the mortgage world when the housing world was down and the investment world was down and people were, unemployed. So a lot of things were going on, and these actually got frozen. You couldn't draw from it. So at a lot of people's greatest need, this wasn't available to them, which, is kind of an issue, right? If you're relying on a strategy, then all of a sudden the bank can pull it out from you. And the HELOCs are also not permanent, right? They end at a point of time. So you might have one for a 10-year period. At the end of 10 years, it goes away. Well, you might be able to go back and get another one. You might not qualify at that point anymore either. Now, another one here, I'm not going to spend much time on, just kind of mention that they exist. And then if you in your state, you might want to see what's available. Sometimes it's worth just talking to a local bank officer to see what policies and programs they have in place. So there's also something called single-purpose loans. They're like a reverse mortgage, like a line of credit, but they're really state organizations, state-run loan programs. And so they often allow seniors and low-income individuals to tap into their home equity, sometimes at low rates with low closing costs, in order to pay certain types of debt, like long-term care or property taxes. Now, some of this one, there's one in Connecticut that had a rate that really, against today's rates might not be that low, but it did have really low closing costs, about $1,500 all in closing costs. That's pretty low for closing costs for a mortgage or reverse mortgage. So, low cost, interest rate okay, I guess, but you needed to be low income and, in order to pay for long-term care. There are some states that have this to pay property taxes and other things. So they're trying to encourage ways for people not to kind of lose their home, not to be able to pay debts, and still offer them a way to, kind of access their home, especially those kind of low income, cash poor, home rich individuals. Then we get over to reverse mortgages, which we've been kind of sprinkling in throughout. A little bit just about some of the features. I'm not going to, that you could do an entire webinar or class really on the features of reverse mortgages. We teach it in the RICP program. There's a number of great books out there. Dan Holquist from Reverse Vision, Shelley Giordano from the Longevity Funding Task Force, Wade Fowle, all have very good books kind of talking about the more detailed aspects of reverse mortgages. So if you decide you want to get a resource that you can use, and all three of them are fairly up to date and recent, so they're pretty good resources. But the reverse mortgage world is mostly the HECM, the home equity conversion mortgage. There's some kind of private company mortgages out there for very large homes, kind of mega reverse mortgages, but we're really not going to focus on them. This is 99+% of the market is the HECM program. Now, the HECM program is kind of backed by HUD, and the Housing Authority here, Federal Housing Authority, FHA, and HUD back this program. It really is a government-directed, regulated, created program that individual companies then deliver the product. So it is very unique in that regard. And there is an insurance program here, too, that you pay into that, in a sense, helps fund the ability for this loan to be non-recourse, meaning that your heirs or you do not owe more than the value of the home at any point. So if your home becomes underwater, you owe more on it than the house is worth, you can just basically hand over the keys. You're done. You don't owe anything else. Bank also does not get a windfall here. They don't become owner of the home when you enter into a reverse mortgage. Now, if you give up ownership later on because you don't want to pay off the debt, that's a different decision, right? You're making a strategic decision to give up ownership because you actually used it well and you actually end up owing more than the house is worth. That's actually a good financial situation for the consumer in the sense of using the product. Now that, that doesn't say anything about the rest of their finances at that point. Now, there are a number of ways you can get access to your home equity through a reverse mortgage. 10-year option, it pays you kind of like an annuity for as long as you live in the house, a lump sum type of option, and line of credit. And we'll talk about the line of credit uses here in another couple of minutes. And that's become kind of the favorite use, or a mix of line of credit and lump sum for financial planners. That might be the best strategic use moving forward. There's also some very good research out there on the 10-year option, comparing that to other annuities and creating a income source. The homeowners need to be age 62. Now, there are some protections out there that they added for a non-borrowing spouse under the age of 62. And there's kind of some, I would say I have on here, but can't be on the title of the home. There's some disagreement out there on that, I think. But they did add protections in that area now to protect the non-borrowing spouse. So if the one spouse that's actually the borrowing spouse enters into this and they die first, then the younger non-borrowing spouse can kind of step in and keep living in the home at that point. So that's been a good change to the system to kind of protect the surviving spouse. Now, if they're both on the mortgage and they're over 62, that's much simpler. We also note that the mortgage does not need to be entirely paid off. there's actually a great strategy, and I think that that's an area worth a lot of growth from a specific just cash flow management. You enter into retirement with a traditional mortgage, flip that to a reverse mortgage, stop having that outflow of cash and payments, and instead basically use up your home equity at that point to make your housing payments, right? So you can continue aging in place. So that's a very interesting strategy that I think is going to grow in popularity here as we see more and more retirees moving into retirement with mortgages. Then the last one here, when is this due? And when this debt becomes due, because you are borrowing from a bank, it's very similar to a traditional mortgage. You go there, they give you money, you're borrowing. Whatever you borrow at that time, if there's an interest rate accruing on it, right? And you have the option to make payments every month, which you can do with a reverse mortgage, but you don't have to. So there's the flexibility of not making payments, which is what most people do. They choose not to make monthly payments because you don't have to, because you don't go into foreclosure if you don't make monthly payments. That's the great feature about reverse mortgages, is that you can borrow without having payments back until when? Until you stop using the home as your principal residence. Unlike a traditional mortgage, you got to make monthly payments, right? So because of that flexibility, though, to choose not to make payments, it means that the bank's not going to get a cash flow today, which means it does have to be more expensive, right? From a general time value of money, it needs to be more expensive for the bank then to make sense. That you have to pay more because you're not making those monthly payments, that they don't have that there's this non-recourse aspect too. So it is a little bit more expensive product than a traditional mortgage. And part of that's because you pay into that insurance fund to protect the non-recourse aspect. Now, how are these kind of reverse mortgages properly used today? Kind of a deeper dive, right? As I said, home equity's not always been part of the retirement income discussion, but it should be. The average age of somebody using reverse mortgages in their early 70s. At one point, that was coming down a little bit, and I kind of heard recently that might have that the kind of downward pool on that might have stopped, so we might still be in early 70s, which the research might not support. We might actually would have liked to see that at an earlier age, maybe mid-60s, early 60s. Historically, a lot of people use reverse mortgages poorly, that this just accelerated their bad techniques and financial planning behaviors, and this was their last resource. They were already spending too much money, and this just was the last asset they had. So at the end, you said, this is bad because they ran out of money. Well, they were on a path to running out of money for 30 years. This was just the last example of them doing something poor with their finances. Compliance issues for companies have been a big issue. We didn't have a lot of research on this in the past, and I do think there was some overly aggressive marketing out there. I think that's, there's still some of that today, but some of that has improved. The government also improved the product over the last 5 or so years. They put a limit on lump sum withdrawals, so you can't take all the lump sum out and buy a boat the next day. That's a terrible decision. And so the government stepped in there. They redid the insurance program fees. They redid some of the costs of this, and so the costs have come down substantially. The insurance program's a little bit a better shape. They added that non-borrowing spouse protection, and then they added a financial assessment piece, which I think was very valuable to have in there a couple of years ago, which is close to what we would say in financial service industry as a suitability requirement, right? That it looks at their income credit and says, hey, can you actually afford the reverse mortgage in the sense of making property tax payments, because those are still going to have to come out of somewhere, insurance payments. And then companies now actually can create a set aside where they set part of your home equity aside to cover those costs, so we don't run into the situation where somebody enters into a reverse mortgage, spends all their other assets, basically becomes broke, can't pay their property taxes, and then loses their home. We don't want that to occur to anyone. That's bad for everyone. It's bad for the bank. It's bad for the government. It's bad for the person. Nobody wins in that situation. This one's just general costs. I don't want to spend a lot of time on this because I know we're getting near the end. I want to give at least 5 minutes to answer a couple of the questions that came in. Doesn't look like we have too many yet, but if you start submitting questions, I'll be happy to deal with it. So there's upfront costs, out-of-pocket kind of general appraisal, counseling fees, origination fees, your initial mortgage insurance premium, depending on how much you borrow, closing costs. And so a lot of stuff that looks generally like a traditional mortgage. Then there are ongoing costs. You'll be paying an interest rate, which is fairly close to market rates there. Now, the part that makes this, again, more expensive, you're going to be paying that annual mortgage insurance premium on the amount of money you have borrowed out at that point. So that really is an additional cost. Then you have your other normal things. If you had homeowner association fees, property taxes, upkeep, you would be continuing to pay those costs too. Now, last bit here is how would you use then a reverse mortgage effectively? Part of it is just include home equity as part of your planning discussion. Today, there's an effective use of home equity to defer Social Security. If you can borrow at 4-5% and get 7 to 8% increase in Social Security each year, that's an effective strategy. Now, as interest rates rise, that strategy might go away. Line of credit, right? Line of credit can function as a lot of benefits here. And what I always say is just think about the simple things, right? That setting up a line of credit with a reverse mortgage, it creates a new asset. It creates a way to tap into your home equity that's not correlated with the market, that's no longer correlated with your house, because when you set up a reverse mortgage line of credit, it's based off your house price at the time you set it up. And then it continues to grow over time. It won't get smaller. It'll continue to grow. And so you get this growing line of credit that's no longer attached to your house value. So you've basically diversified your home, which is your client's single most non-liquid, non-diversifiable asset. By adding a reverse mortgage, you help diversify that. And I think that's incredibly valuable. And so when would you use that? Well, then you would tap into the line of credit in the 2008 when the market drops 40%. Would you rather borrow at 4.5% from your line of credit, or sell your assets down when they're down 40%? Well, we know the math there. The math has been shown over and over and over again. You will drastically improve your client's retirement portfolio sustainability and duration if you use the home equity in those down market years, and then you can pay it back when the market goes back up, and it works incredibly well. I think from a cash flow management situation, flipping a traditional mortgage to a reverse mortgage, then continuing to make payments, and then if you have a bad year, just not making payments for a year, that can be an effective strategy. And because a reverse mortgage is a loan, right, that you're borrowing money, it can be a very tax-efficient vehicle because you're not increasing your adjusted gross income, which can allow you to do some Roth conversions and some other tax-efficient withdrawals during those years. So especially if you're somebody who's being subject, right, to that additional investment income tax at 3.8%, well, if you can wipe that out by using a reverse mortgage and you're borrowing at 4%, well, you've been pretty effective there just from that standpoint alone, that it almost saves you in that cost. Then I had about 2 more slides there, and I just want to kind of get here and conclude now. And I see, Brendan, would you like to, do we get any good questions come in here, or should I just kind of wrap up?
Jamie, we have a very good question from Joe, if you'd like me to go ahead and read that out loud.
Absolutely. Hopefully I can answer Joe's question.
All right. His question is that he has a 67-year-old client, and she wants to purchase a home where she and her 70-year-old husband can age in place, assuming the cost will be $500,000, and they put $250,000 down. He'd like to better understand the cost differences between using a regular or reverse mortgage. Are the costs the same? For example, number 1, compare the closing and other setup costs for both. And number 2, what is the monthly mortgage payment for a regular mortgage? What is the monthly payment if I used a reverse mortgage?
So that is a great question. Now, unfortunately, I'm not going to be able to give the exact numbers there, but there is a program, again, backed by a Federal Housing Authority and HUD, called a HECM for Purchase. My suggestion would be, in that case, it actually seems like a client that would be a good fit for a HECM for Purchase. Now, it is better to do a HECM for Purchase when you buy the new home than to buy the new home, go through all the closing costs of buying the home, and then later decide to set up a reverse mortgage. That's going to be more cost. So if they're going to do it, they should do it at the purchase. It will be, again, slightly more expensive to set it up. At that point, closing costs are going to be pretty much the same. There will be that initial mortgage insurance premium amount that's going to be there that you're going to pay, that's going to be a little bit more expensive than the traditional. And then, as I said, you can continue to make mortgage payments, and you could actually just choose to make the exact same mortgage payment that the traditional mortgage would have been. And in that situation, if you're putting down $250 on a $500, you're probably still paying down the mortgage there, right? So you can make the exact same monthly payments as you would be with a traditional. It just means that the payoff time period would be longer, but it gives them the option at any point in retirement that they decide that they don't want to make payments anymore. They can just say, you know what, we don't want to make payments this month or next year. And so it adds a lot of added flexibility for that client situation.
Excellent. And just as a reminder to our participants, we do have a few more minutes for questions. If you'd like to type your question into the question box on the right side of your screen, Jamie will be happy to answer that for you.
Okay, and I'll wait. I'll kind of close up with some of my closing thoughts, and if there's another question that comes in, I'll be happy to answer it. So, first thing I want to thank again RFS Retirement Funding Solutions here for sponsoring this. And if you do want to talk to somebody from Reverse Mortgages, again, rfslens.com. I don't work for them, but a great company out there. And remember, this is your client's largest asset. Most don't consider home equity despite having an advisor, because advisors really don't do a lot today with home equity. So despite the fact that Wade Fowle, John Salter, Barry Sachs, very high-level researchers have said using a coordinated strategy with home equity and your withdrawals improves your client's situation. So I always find it hard, right? Why would we ignore strategies that have been shown to improve our clients' situations? But that means, right, we have to learn about this and talk to our client about what they want, how they feel about home equity as an income source, and reverse mortgages in general.
Well, that does seem to be all the time we have, and also all of the questions that we have. And so I want to thank all of our participants today for participating in our webinar, Best Practices for Utilizing Home Equity in Retirement, sponsored by Retirement Funding Solutions. And I'd also like to thank very much our presenter, Professor Jamie Hopkins. And we have one late-breaking question that we can definitely take, because Joe would like us to give the website again, please. Can you provide that, Jamie?
Yes, it's RFS Lens. So RFS Lens. It actually was on one of my earlier slides. Let me see if I can get back there. And you can type it down off the screen. I think on their sponsor slide, it did have their website. I've got too many slides. That's what you learn when you try to click back. But yeah, right there on the, you might even be able to click on it on the screen right now. It's www.rfslens.com, Retirement Funding Solutions. And again, they do have reverse mortgage specialists in most states, most areas. So you could actually meet with somebody as an advisor, sit down, see if you like them and want to work with them. So you don't have to do everything by the phone and internet there.
Outstanding. Well, thanks for that, Jamie, and thanks again to all of our participants. This concludes the NAFA webinar.